Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Ford stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Ford is an auto manufacturer with its headquarters in Dearborn, Michigan. It was founded by Henry Ford and incorporated in 1903. Ford introduced methods for large-scale manufacturing of cars and large-scale management of an industrial workforce using assembly lines. This process was revolutionary at the time. It is the second largest US-based automaker behind GM and the fifth largest in the world. It sold 2.4 million cars in 2019, which is 14% of US sales. Let's get started with the model. This is a large cap company. 34 billion market cap. They're trading at $8.65 a share, and they have 3.9 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the future free cash flows, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has lots of free cash flow each year, 11 billion up to 16 billion. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they did have negative net income in the trailing 12 months. Revenue seems to be on a decline. It was 156 billion. Currently it's down to 131 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is cost of revenue. And then gross profit is revenue minus cost of revenue. And that was the lowest in the trailing 12 months, mainly because of their low revenue. Operating expenses were higher than their gross profit, so they had negative operating income, and it was positive in prior years. The company has lots of debt, so they have a pretty high interest payment on their debt, and then there's other income and expenses. So in the trailing 12 months, they had negative net income. In prior years, it was positive. It seems to be going down a lot each year. This is the company's statement of cash flows, and the top line is operating cash flow. That's how much cash the company generates from its operational business. And then you have capital expenditures, which are investments in property, plant, and equipment. And when you take operating cash flow and combine that with CapEx, you get your free cash flow. And that was the highest in the trailing 12 months, $16 billion of free cash flow. And the company issued $47 billion of debt in 2017 and paid down $41 billion. So they increased their debt load $6 billion in 2017. They increased their debt $6 billion in 2018. They increased it $1 billion in 2019 and $4 billion in the trailing 12 months. Even though the company is generating operating cash flow, they have so much debt that they have to issue new debt to pay down the old debt. Let's look at their operating cash flow, because even though they had negative net income, they had their most operating cash flow in the trailing 12 months. Let's figure out why. The way you calculate operating cash flow, you start with net income, negative 157 million, and then you have to add or subtract the non-cash items from the income statement. They had 7.8 billion of depreciation, so we have to add that back. They had $1 billion of write-offs we have to add back. In order to calculate operating cash flow, you have to look at changes in working capital. And this company had a positive $10 billion in receivables in the trailing 12 months. If you sell something on credit, that means you're providing a customer with a product but not receiving any cash for it. They're going to pay for it in the future. It's an IOU. The company had negative $3 billion in 2017 in accounts receivable, negative $4.6 billion in 2018. So that means they sold $3 billion on credit in 2017 without receiving any money for it. So this $10 billion they received, it could have been stuff from a year ago or even 2 years ago. But the statement of cash flows is actual cash that you received in that time frame, where the income statement uses accrual accounting. So some of the dollar amounts on the income statement could have been from years ago. So the company received $10 billion of payments in the trailing 12 months, so that increased their operating cash flow. That's why it's $22 billion in the trailing 12 months, much higher than in prior years. Let's look at a capital structure. 33 billion of equity, 156 billion of debt. So they have 17% equity in a capital structure, 83% debt. and their net debt is $122 billion. Their WACC is 14.2%, which is a blend of the cost of equity and cost of debt, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $51 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $56 billion. We divide that by 3.9 billion shares. And we get a calculated stock price of $14.34. They're trading at $8.65, so they're trading at a 40% discount. It's a buy according to the model. Simply Wall Street values the company at $1.70, so they're saying it's really overvalued. They're saying it's a sell. From 2016 to 2020, the stock has gone down little by little. Then it took a real big dive in March like everything else, but it's come back up almost to where it was before the March crash. But the stock was trading around $13, $14, so it's well below that price. In 2020, the company suspended its dividend payment, so it's not paying a dividend anymore. It's trying to conserve cash. It may pay one in the future. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $7,100 today. If you did not reinvest the dividends, you'd have $7,500 today. So this is $10,000 10 years ago, and you're pretty much down the entire time. There's only 2 small time frames where you would be up over $10,000, but for the rest of the time, you would have lost money regardless of when you sold. And if you sold in March, you would have sold at $4,000. It's come back up to $7,100, well below the $10,000 investment. The company has a beta of 1.28, so the stock isn't too volatile. And the stock has gone down about 8% in the past 52 weeks, compared to the S&P 500, up 14%. And the low was $4, the 52-week high was $9.50. And the stock is trading above its 200-day moving average, but below its 50-day moving average. And this is a really liquid stock. 50 to 60 million shares are traded each day. And almost all the shares outstanding are on float, so they are available to investors. And a little more than half the shares are held by institutions, and it has a pretty low short percentage, 281 basis points. In an article last week, a spokesman at Ford talked pretty negatively about Tesla's quality issues. And this person promises that Ford electric cars will be much better quality. Ford is trying to really focus in 2021 on the Mustang Mach-E. This is Ford's first all-electric vehicle. And some automobile experts, not associated with Ford, said this is the best car of 2021. State Street is the biggest shareholder at 9%, then Vanguard, BlackRock, Newport Trust, and Geode. Let's look at the financial ratios. The average PE in the market's 12, the median is 14.7. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 0.3, so they're much better than the median and average. 0.3 means investors are paying 30 cents for $1 revenue. Price to book is stock price over book value per share. They're at 1.0, much better than the median and average. The way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $33 billion of equity. Almost all their equity is tangible, $32.7 billion. A price to book value of 1.0, that means if the company sold all its assets, paid off all its liabilities, they could then return $8.50 to each shareholder, almost their entire share price. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They're at 1.2, so that's good. They can cover their current liabilities. And their current assets are $35 billion of cash, $63 billion of receivables, and $11 billion of inventory. So the company does seem to be well capitalized. They did have $16 billion of free cash flow and $15.9 billion of working capital. The best way to look at ratios to compare them to similar companies, I've done videos on GM, Green Power, Li Auto, NIO, Solo, Tesla, Workhorse, and XPeng, all in the same industry as Ford. And if Ford has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE. They do have a much better price to sales and price to book ratio. They're doing fine in current ratio. They are better than average in ROE because the average is negative. They have a lot of debt, more than average. And they are smaller than the average company, 34 billion market cap. Just because Tesla is so big, it drags the average so much higher. So to summarize, I do have them trading at a 40% discount. Of course, there's a lot of risk because they have so much debt, but they do seem to be bringing in lots of free cash flow. And if they could break into the EV market, the stock price should go even higher. That could be really difficult because Tesla has a stranglehold over that market, especially in the United States. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.